Out on the open ocean, thousands of massive cargo vessels physically connect the global economy, moving trillions of dollars of physical goods every single day. But the financial machinery powering all this movement relies on a strange paradox. Imagine a mining company in Chile selling a shipment of raw copper to an electronics manufacturer in South Korea. The copper never gets near the United States. The buyer and seller are thousands of miles from North America. Yet the contract they signed to execute that trade is almost certainly written and settled in US dollars. To understand why that happens, we have to look at how a currency actually dominates the globe. It comes down to three functions: pricing commodities like metals and oil, conducting international trade, and serving as foreign exchange reserves. Foreign exchange reserves are simply foreign currencies held by a country's central bank to help manage their domestic economy and facilitate international transactions. The dollar is the primary currency used for all three. Because the world relies heavily on this single currency, policy decisions made inside the U.S. central bank, the Federal Reserve, instantly impact the global economy. When the Fed adjusts interest rates to manage domestic inflation, it simultaneously tightens or loosens financial conditions for businesses and governments worldwide. The global economy tolerates this setup because the dollar effectively functions as an operating system. It provides a common language and a standardized metric of value that allows entirely different nations to do business with minimal friction. This global operating system has its roots in the aftermath of World War II. With much of the industrialized world rebuilding, delegates from 44 nations gathered in 1944 to draft the architecture for a new, stable financial order. The result was the Bretton Woods Agreement. Under this system, the US dollar was physically tied to gold at a fixed rate of $35 an ounce. To maintain stability, every other participating nation agreed to peg their own currencies directly to the US dollar. That system held for nearly 3 decades, until 1971, when President Richard Nixon officially severed that connection, ending the gold standard. By then, however, the structure of global trade was fully reliant on the dollar. Governments and businesses simply continued using it out of necessity and habit. That early post-war agreement gave the United States an enormous head start. It established a structural monopoly that, instead of eroding over time, began to compound and lock itself in place. Today, that dominance is no longer maintained by a gold peg. Instead, it is driven by the massive scale of modern commodity markets. Consider the global oil trade. Oil is priced universally in US dollars. If a country wants to import energy to power its cities, it first needs to acquire dollars to pay for it. This creates a perpetual, mandatory global demand for the currency, an arrangement commonly known as the petrodollar system. This creates a unique logistical problem. When oil exporting countries and massive manufacturing hubs accumulate billions of dollars from global trade, they cannot simply leave that cash sitting in a checking account. They need a place to safely store it where it will generate a return. The primary destination for that wealth is U.S. Treasury bonds. Treasuries are essentially loans made to the U.S. government, and they are widely considered the safest, most liquid investment vehicle on Earth. Liquidity simply means an asset can be rapidly bought or sold in massive quantities without significantly altering its price. Because foreign governments continually pour capital into these bonds, U.S. financial markets achieve unmatched depth. There is always a buyer and always a seller, ensuring that investors can move billions of dollars in seconds without crashing the market. This cyclical flowchart maps the sequence of how a network effect actually works in global finance. Because oil requires dollars, global demand for the currency rises. Those dollars are then parked in U.S. Treasuries, which deepens the stability of American markets. That immense stability increases global trust in the dollar. These factors constantly feed into each other. Businesses prefer the dollar because partners use it. Countries hold treasuries because other central banks hold them. The value is generated precisely by shared participation. This specific economic loop functions as the primary architecture of global finance, cementing the dollar status as a self-reinforcing system. There is a constant global discussion about finding an alternative. Competing currencies absolutely exist, specifically the euro, the Chinese yuan, and the Japanese yen. Yet, each faces severe limitations. The Chinese yuan represents a massive manufacturing economy, but the government maintains strict capital controls over how money moves and out of the country. That political structure restricts the widespread global trust required for a central bank to confidently hold its national reserves in yuan. The euro, on the other hand, enjoys high trust among international institutions. However, its underlying financial markets are fragmented. Instead of one massive unified bond market like the US Treasury system, Europe has multiple distinct sovereign bond markets, diluting the liquidity and depth required to absorb global wealth. The United States possesses a specific combination of traits that neutralize these challengers: a remarkably high gross domestic product, robust institutional frameworks, the rule of law protecting foreign investments, and the deepest capital markets in existence. The dollar dominates by satisfying the distinct requirements of trade, investment, and sovereign reserves in a single, unified package. Dethroning the dollar necessitates a global consensus to abandon an 80-year-old operating system simultaneously. A larger economy alone cannot overcome that level of institutional inertia.